If Warren Buffett had to start over today with just $1 million or $100,000, what'd you think he'd do? Chase the latest meme stocks? Go all in on crypto? Yeah, not a chance. Buffett's game is all about finding value, and the good news is his strategy works just as well for small portfolios as it does for billions. In fact, I've found 3 of the most undervalued, high-moat stocks using Buffett's principles. Now, I know what you might be thinking. How do I spot these opportunities? That's where today's video comes in. I am diving deep into Buffett's playbook, breaking down his core principles like intrinsic value, margin of safety, and economic moats. But we're not stopping there. I'm going to show you how these principles apply to real-world stocks that you can research right now. In the end, I will show you the undervalued stock that I found and what would happen if you invested $100,000 into these stocks. Warren Buffett has always been a man of strategy, but his recent moves have left a lot of people scratching their heads. Over the past year, he's been selling off billions in stocks of some of the biggest holdings, like Apple and Bank of America. But here's where it gets really interesting. At the same time, Buffett's been on a bit of a shopping spree, adding Occidental Petroleum, SiriusXM, and VeriSign to his cart. These are not flashy, high-growth tech stocks that you see plastered all over financial headlines. So, what's the big picture here? What's the method behind this apparent madness? Well, there is a pattern. A calculated shift from selling what's overvalued to buying what's fundamentally strong. And it's the pattern, the cornerstone of Buffett's strategy that we're about to unpack in the next section. Let's get one thing straight. Warren Buffett's success is not built on some secret formula or insider tricks. It's built on principles that are simple, logical, and repeatable. The best part? They work just as well for a $100,000 portfolio as they do for a $100 billion one. So let's break it down. At the heart of Buffett's strategy is a concept called intrinsic value. Simply put, it's what a company is truly worth based off its fundamentals, things like earnings, assets, and growth potential. Now, the stock market can get this wildly wrong. Prices go up and down based on hype, fear, or even pure speculation. But intrinsic value, that's the anchor that keeps you grounded. Here's how Buffett looks at it. Imagine you're buying a house. You wouldn't just pay whatever the seller is asking. You'd compare the price to its actual worth based on the neighborhood, the condition, and the market trends. Stocks, they're no different. Buffett calculates what a company is really worth, then waits for the market to offer him a deal. That's where the margin of safety comes in. Think of it as a buffer between what you pay and what something's worth. If a stock's intrinsic value is $50 and you can buy it for $30, well, you've got a solid margin of safety. This buffer protects you if your analysis isn't perfect, or if the market takes a nosedive. Here's the thing about Buffett. He's in no rush. While most investors chase the next big thing, Buffett plays the long game. He famously said, "The stock market is a device for transferring money from the impatient to the patient." And he means it. Patience is key for 2 reasons. First, it helps you wait for the right opportunity. Buffett doesn't buy stocks just because he has cash burning a hole in his pocket. He waits for them to be cheap. Second, patience gives investments time to grow. Look at Coca-Cola. Buffett started buying shares in 1988 and still holds them today. Why? Because the business continues to perform. And here's the reality check. Patience isn't always exciting. It might mean holding cash for months or even years waiting for the right opportunity. But when that opportunity comes, Buffett pounces, and that's what separates him from the crowd. Now let's talk about one of Buffett's more controversial beliefs, diversification, or more accurately, his lack of enthusiasm for it. Buffett once said, "Diversification is protection against ignorance. It makes little sense if you know what you're doing." So, does that mean you should pour all your money into one stock? Not quite. Here's how Buffett sees it. If you're confident in your research and understand a business deeply, it's okay to concentrate your investments. In fact, it's better. Why spread your money thin across 20 companies when you could focus on the 5 to 7 you really believe in? But here's the catch. Concentration requires confidence, and confidence comes from research. If you're not willing to put in the time, Smart diversification is the way to go. For smaller portfolios, this might mean owning a handful of carefully selected stocks across different industries, ensuring you're not overly exposed to one sector. One of Buffett's favorite concepts is the economic moat. Think of it as a company's competitive advantage, something that protects it from competitors and allows it to thrive over the long term. Moats come in many forms: brand loyalty, cost advantages, exclusive technology, or even regulatory barriers. Take a company like Coca-Cola. Its brand is so powerful that even if another soda company tried to replicate the recipe, it wouldn't matter. People don't just drink Coke, they're loyal to it. That's a moat. And when Buffett invests, he looks for companies with strong moats that ensure consistent profits for years to come. Now, spotting a moat isn't always obvious. Some are easy to see, like Apple's ecosystem of devices and software. Others are more subtle, like a manufacturing company with the lowest production costs in its industry. These strategies, intrinsic value, margin of safety, patience, concentration, and economic moats, are the bedrock of Buffett's success. They're not reserved for billionaires. Anyone can use them. The key is discipline. Now you might be wondering, how do I actually find these opportunities? And what does this look like in the real world? Don't worry, because that's exactly what I'll cover next. In the end, I'll show you what would happen if you invest $100,000 into these stocks. Now that we've explored Buffett's core principles, let's see how they work in action. Imagine for a moment you're scouting for stocks just like the Oracle of Omaha. With strategies like intrinsic value, margin of safety, and economic moats, how would you apply them in today's market? Well, let's dig into 3 stocks that caught my eye: Dell Technologies, Mohawk Industries, and Weatherford International. Dell Technologies is a household name in hardware. It's evolving into a major player in enterprise solutions and cloud computing. According to recent valuations, Dell's intrinsic value is $155.65, while its current market price is $119.91. This puts the stock at an undervaluation of 23%, creating a margin of safety. For a company like Dell, which has transitioned into higher margin services, this gap suggests the market might be underestimating its long-term potential. Buffett, if he were to invest $100,000, would look at this undervaluation and think, do I have enough cushion if my calculations are wrong? With a diversified revenue base and steady growth in enterprise solutions, Dell offers a reasonable margin of safety for investors. Its competitive advantage lies in its strong brand, customer loyalty, and integration of hardware with enterprise solutions. While competition in the tech space is fierce, Dell's ability to innovate and maintain market share in its core areas adds to its moat. Dell is a textbook example of a company with solid fundamentals and a price that might not reflect its full potential. Next up is Mohawk Industries, a global leader in flooring and home renovation products. Mohawk is all about steady fundamentals. Mohawk's intrinsic value is pegged at $173.33, compared to its current price of $117.55. That's an undervaluation of 32%, providing a significant margin of safety for potential investors. With a history of being undervalued by an average of 19% over the past 5 years, Mohawk's 32% discount suggests the market isn't fully appreciating its resilience in a challenging economic environment. Mohawk's moat is rooted in its manufacturing efficiency and market leadership. The company's ability to produce high-quality products at scale gives it a cost advantage over competitors, ensuring profitability even in tight markets. Mohawk is a classic value play, stable, undervalued, and built to weather economic cycles. Finally, we have Weatherford International, a company that operates in the oilfield services industry, a sector often plagued by volatility. But as Buffett would say, be fearful when others are greedy, and greedy when others are fearful. Weatherford's intrinsic value is estimated at $123.46, while its market price is just $72.79, a massive 41% undervaluation. That's a significant margin, indicating the market might be overly pessimistic about its prospects. especially when you see Warren Buffett's most recent buys in the energy sector. A 41% discount provides a substantial buffer for errors in valuation or unexpected market swings. However, caution is warranted. Now let's say you decide to invest $100,000 into each of these undervalued stocks today. Using their intrinsic value as a guide, we can calculate the potential returns if these stocks were to reach their fair valuation. While this exercise isn't a prediction of future performance, it is a helpful way to visualize how Buffett's principles could translate into real-world gains. First, consider Dell Technologies. With a current market price of $119.91 and an intrinsic value of $155.65, Dell is undervalued by 23%. If you invested $100,000 in Dell, you would buy approximately 833.9 shares. If Dell stock were to rise to its intrinsic value of $155.65, your investment would grow to $129,714.24, delivering a profit of over $29,000 and a return of nearly 29.7%. Next, let's examine Mohawk Industries. With a current price of around $117 and an intrinsic value of $173, Mohawk is undervalued by 32%. Investing $100,000 at this price would buy you approximately 850 shares. If Mohawk stock were to rise to its intrinsic value, your investment would grow to $147,444, delivering a profit of over $47,000 and a return of 47.4%. Finally, there is the Weatherford International. Trading at $72 with an intrinsic value of $123, Weatherford is undervalued by a striking 41%. A $100,000 investment would buy you 1,373 shares. If the stock reached its intrinsic value, your investment would grow to $169,469, resulting in a profit of over $69,000 and a remarkable 69.5% return. Now you've got the tools to start thinking like Buffett, but how do you make it work for you? Let's break it down into 3 simple steps. First, start small, think big. You don't need millions to invest like Buffett. You just need focus. Even with $1,000 or $10,000, the same principles apply. Look for undervalued companies with strong fundamentals and a margin of safety. Stay disciplined. The stock market is unpredictable, but Buffett's strategies help you stay grounded. When others panic, see it as opportunity. Focus on the fundamentals. Is the company undervalued? Does it have a margin of safety? If the answers are yes, trust your research and block out the noise. As Buffett says, patience pays. The bottom line is, investing isn't about chasing hot stocks or timing the market. It's about understanding value, being patient, and staying consistent. Whether you're starting with $100 or $100,000, the principles remain the same. Want to know what Buffett is buying right now? Click the video on the screen to find out.